Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Luis, and I'll be guiding you through the latest news and trends that are shaping the market. Today, we're going to take a closer look at the ongoing trade tensions between the US and other countries, and how they're impacting the global economy. We've got a story from the Economic Times of India that caught our attention, featuring an interview with G.F. Dennis, a renowned expert on global trade and finance. According to Dennis, the markets have gotten used to the deadlines being pushed back and forth between the US and other countries, but if these tariffs were actually imposed, it would cause significant volatility in the markets. He believes that the number of deals made by President Trump on trade has been limited, and that the policy is absurdly absurd and not good for the global economy or the U.S. Dennis also shared his thoughts on the recent FOMC minutes, which showed a divergence in opinions among officials about the outlook for interest rates. He believes that we'll see 2 rate cuts this year, one in September and one in the fourth quarter, due to a softening labor market and a relatively controlled inflation story. It's worth noting that Dennis emphasized that Chair Powell will not cut rates just because President Trump tells him to, but rather because of the underlying economic conditions. He also highlighted that the impact of tariffs on U.S. inflation is still uncertain and has not been fully felt yet. As we navigate this complex landscape, it's essential to stay informed and consider multiple perspectives. We'll continue to monitor the situation and bring you updates and analysis from experts in the field. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and markets. In our previous segment, we explored the latest trends in global economics. Now, let's shift our focus to a fascinating story that's been making waves in the Indian stock market. You might have heard about Prime Focus, a post-production and visual effects company that's behind the highly anticipated film Ramayana. The company's shares have seen a remarkable surge of over 90% since April, and it's not hard to understand why. With a stellar lineup of talent, including Bollywood actor Ranbir Kapoor, who plays Lord Rama in the film, investors are clearly excited about the project's potential. But what's really interesting is that Ranbir Kapoor has also invested in Prime Focus, acquiring 12.5 lakh shares at Rs 120 apiece, which translates to an estimated investment of around Rs 15 crore. This move has further fueled the rally in the company's share price, with the stock touching Rs 163.1 in recent trade. Now, it's essential to note that while this news is certainly attention-grabbing, investors should always approach such stories with a critical eye. We must consider the underlying fundamentals of the company and the industry as a whole before making any investment decision. Prime Focus has indeed established itself as a global player in the VFX and animation industry, with an impressive portfolio that includes work on major Hollywood films like Tenet and Dune, Part 2. The company's reputation and expertise in this field are undoubtedly assets, but it's crucial to separate hype from reality when evaluating investment opportunity. As we continue to monitor the developments surrounding Prime Focus and the Indian stock market, we'll keep a close eye on how this story unfolds. Will the company's shares continue to rise, or will investors take a more cautious approach? Only time will tell. Stay tuned for our final story of the day right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's episode with a story that's making waves in the pharmaceutical industry. You might have heard that U.S. President Donald Trump has threatened to impose a 200% tariff on pharmaceutical imports into the United States. Now, this move has significant implications for Australian pharmaceutical giant CSL, which is a $117 billion ASX giant and the nation's biggest player in pharmaceuticals. Now, CSL is exposed to these hefty tariffs, but analysts say the company is well insured by its large overseas operations, including its facilities in the US, and the critical nature of the medicines it makes. The company has a long history, dating back to 1916 as a vaccine manufacturer for the Australian government, and it still makes products in Australia and exports them to the US. CSL has been vocal about its opposition to these tariffs, submitting a 7-page letter to the US government in May, highlighting the potential disruption to US patients' access to therapies, increased cost for patients and the healthcare system, and the impact on domestic prices. The company is also pointing out that it has invested heavily in the US, with over 19,000 employees across 44 states, and has created thousands of new jobs. Now, we're not here to take sides or make political commentary, but rather to provide you with a balanced view of the situation. It's clear that CSL is taking a proactive approach to mitigate any potential risks, and its presence in the US will likely help it weather the storm if these tariffs are implemented. As Hugh Dive, Chief Investment Officer at Atlas Funds Management, which holds CSEL shares, noted a lot of their stuff doesn't really cross borders, and the company's products are vital to ongoing treatment of patients. So, while there is some uncertainty surrounding this issue, it seems that CSL is well positioned to navigate these challenges. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.